Hey everybody, Mike Molina. It is Wednesday, July 26th, and the big day has come and gone. The Fed did exactly what we knew they were going to do and raise the Fed funds rate 0.25%. And then the all-important meeting happened with the comments. And as you can see here, this is a bit of a different chart than I usually show you. This is the intraday chart. It shows all the activity for every hour of the day today. And you can see right throughout the whole day, the market's just holding its breath. And then the comments came, and as you can see, the comments were positive, and the market reacted positively, and it came tumbling down. This is, of course, the 10-year Treasury, which rates tend to follow. So what did that do? That sent interest rates down 0.1% to 6.5 for a conventional 30-year fixed with a 1-point cost. Now, why is it so important? Well, it's so important that what the Fed is going to do is actually tracked on a website. And you can see here, they're already counting down the days, hours, minutes, and seconds to the next Federal Open Market Committee meeting to see what the Fed is going to do. And even more interesting than that, they are taking bets about what the Fed is going to do. So right here, this window, if I blow it up, the probabilities that the Fed is going to ease the Fed funds rate are, of course, 0. Nobody believes that's going to happen. 77% of people believe that they're not going to raise the rates anymore, and 23% of the people believe that they're actually going to raise the rates another quarter. So the outlook is good that they're pretty much done raising rates for now. We'll have to see. Ultimately, the decision rests with the Fed, and they're a bit unpredictable, and you never know what they're going to do. But outlook is good. All right. So, in other news, new home sales came out today and showing an annualized pace of 697,000 new contracts. So that's annualized. That's a month-over-month decline of 2.5%, but a year-over-year increase of 23.8%, basically 24%. That is a high in sales in the past year, believe it or not. So that is good news. Now, I really want to break this down for you. So if you'll just bear with me a minute and take a deep dive with me, because this is where you can really get into understanding what is going on in the market and why the narrative about there being a crash coming up is not true, and you can share this information with your clients. So, as I just said, we have an annualized sales pace of new home sales of 697,000, okay? That is a monthly sales pace of 58,000, right? So, the total current inventory right now, homes for sale, is 432,000. Well, if we divide that by the monthly sales pace, that means we have a 7.4 month supply. This is what you're going to hear on the news. This is what the media is going to tell you that we have a glut of inventory and that we're headed for another housing crash, because this is what they're looking at. However, what they are not taking into account, that of the 432,000 homes for sale, most of those are just air or a lot. They're not actually completed homes. Those are mostly homes that still have yet to be built. So if you look at the actual available completed number of homes out of this 432,000, which is 72,000 homes, and divide that by the monthly sales pace, now the actual month supply, you can see, is only 1.24 month supply. This is what is not reported, and this is why people don't understand that, we're headed for a crash because we have a glut of inventory. We do not have a glut of inventory. We have a shortage, and this is how you can explain that to your clients and prospects. You've heard me talk a lot about household formations and inventory and why we're not headed for a housing crash because of the housing crisis. So let's take a look at history and where we are now. So this is a graph of existing U.S. housing inventory, which is this purple line here, and household formations, which is this line right here. These are, of course, annualized numbers. So here, this red line here is July 2007, right when the big crash happened, right? And this red line here is today. So in 2007, there was 4.04 million units for sale on the market. There was so much speculation and so much building going on. There was a literal glut of inventory. And there was only 691,000 household formations. That is why the housing crash happened. All the fraud and everything else aside, the crash happened because there was way more supply than there was demand. Then, of course, the crash happened, and as you can see, the inventory has been decreasing, the household formations have been increasing, and since about 2018, we've had a steady of household formations above inventory. And right now, as of June, we have 1.532 million household formations as opposed to 1.08 million household housing units in inventory for sale. That is why the appreciation is continuing, and that is why there will not be a housing crash. So use this information to explain to your prospects and clients, and hopefully they can understand that what they're hearing is just not reality. That's it for today. Thank you so much for watching. If you have any questions, please don't hesitate to let me know. And as always, the slides are available for download by clicking the link in the description on YouTube. Have a great day, and we'll talk with you soon. Take care.